Hey guys, Vulcan Trader here, and today we got a video for you on how to use the general market to have your stocks in your favor. And my last video I made was the trend is your friend and how to use moving averages, and so this one's kind of the next step in that. So I showed you on the last video how to use moving averages, know if the stock's in an uptrend, and to if it's above certain moving averages, and to use that to go in the right direction of the general market, or to go in the direction of the stock. Okay, and then there's other factors that affect a stock, and that is what is the general market doing, which is kind of a reflection of the general economy and things like that. So here's a good quote by let's see, where's it at? Okay, from Steve Cohen here. It said, he said, they taught me that 40% of a stock's price movement was due to the market, or 40% was due to the market, 30% to the sector, and only 30% to the stock itself, which is something that I believe is true. I don't know if the percentages are exactly correct, but conceptually the idea makes sense. Okay, and I'd say this is pretty much generally true. I don't know if it's 40% to the market. I'd say maybe 33, 33, 33, or something like that. Or, it's going to vary from stock to stock too. But in general, this is true. And what you'll see happen is, even if maybe your stock is doing good, the company is even doing fine, there's no problems with it. Even if there is a recession, this stock is recession proof, whatever business in, let's say. It really won't matter, and whatever happens to the general market will usually affect your stock. And if it doesn't, we'll show you kind of what to do in that case, or probably should do. But so, for example, so here's the S&P 500, and we got a list of indexes here. We kind of go over what each different one is. But this is the S&P 500, or the SPY, which is an ETF that tracks the S&P 500. So you just type in SPY here if you wanted to bring that up. And we got our 50-day moving average, which is the green line. The red line is the 200-day moving average. And in general, whenever the indexes are in an uptrend, so like, see right here, the indexes are above the 50-day moving average for the most part this entire time. This whole uptrend from, it was about the time Trump was elected, or somewhere in that neighborhood, until beginning of 2018. So you'll see that most of the rest of the stocks in the market will continue and go in a smooth uptrend and won't have giant pullbacks, etc. Then you get to in the last couple years, you have times where you get that a little bit, and you'd see, during this period, you'd have a little bit smoother, but right here is like everything was going up and down. You got a lot of volatility. Volatility just means everything. Usually whenever things are getting bearish and everything's selling off really hard and it's going back and forth really fast, and it's hard to catch stocks in an uptrend in that environment. And you'd see that most even good stocks, turned around, pulled back in that time, and then especially from about October 2018 till December, about Christmas time of 2018, and then we've had a recovery since then. And so, but what you can do is, so you want to create a rule probably in your trading system and say, okay, well, depending on your time frame, how long-term invest you are, maybe say, oh, if the general indexes aren't above the 50-day moving average, then I don't want to maybe add any more positions to my stocks. Okay, so, and the reason being because if anything you buy might just be affected by the general market until we kind of get out of this type of thing. And I think this is timely because we had this kind of situation where, well, above 50-day moving average, a little pullback here behind it, and then stocks are going up smooth, it's doing well, and then now we had this correction, and the 50-day become resistance at this point, you see, and the indexes are having a hard time getting above it on the S&P 500, which, if I didn't explain this, S&P 500 is the 500 largest stocks in the stock market. So, and whatever they do kind of leads the others. And then the NASDAQ, which is NDX here, which is the top 100 largest NASDAQ stocks. This is your Microsoft, your Amazon, your Google, your Apple are the biggest ones. And the same thing with the S&P 500. They're both in both of all these stocks are in both those indexes, all these largest tech stocks. And you'll see the same thing happening here. Microsoft just broke its 50-day moving average. Amazon is below the 50-day moving average here. Google's actually above it, but Google's pretty much been going sideways, just like the indexes has. It hasn't really been going up. If you'd have bought it, it's like, you'd be down, then you'd be up, down, up. Apple was in an uptrend, see, along with the general market, had the pullback exact same time as the indexes, and that's partially because Apple is one of the biggest companies, so it makes up the move of the index, and it's going to follow kind of what the other general stocks are doing. And it's just broke below its 50. We'll see maybe if it can hold it or not, but so maybe say you had Apple and you're using the 50 days, your trailing stop, something like that, or something below that. Maybe if you got stopped out, you would want to add it back until the general market recovered to something along those lines. And then Facebook, another big one below its 50-day. And so that's why these indexes are doing that, and all the rest of the other stocks in the market will do that. Just because maybe all the big institutional money is taking money off the table because they think that there's a recession coming, whatever, or some news that Trump put out about tariffs. You really don't know. Until that thing is over, you kind of want to be out of the market or not add any new positions and put on any more risk. So, and then here's the MDY, which is all your mid-cap stocks, 400 mid-cap stocks. I want to say that's like $1 billion to $20 billion or somewhere in that neighborhood. And then the Russell 2000, which is all your small-cap stocks. I think under $1 billion-ish or somewhere in that neighborhood. I'd have to look it up, but you can see the same thing here under the 50-day moving average, and that also means we could have a drop lower. Maybe it'll hold up and go up. We really don't know, but you're gonna kind of wait until that's gone to figure out what direction the market's gonna pick, and the rest of the stocks will pick. Okay, and same thing here with the Russell. And whenever that's happened, you go here to FinViz, and on their front page, they'll say, okay, well, one's advancing, declining, one's making new highs, new lows above the 50-day simple moving average and or below. See, most stocks are below them. Means most stocks are in at least a intermediate term downtrend, and then 200-day moving average, you got most stocks below the 200, which means most stocks are in a somewhat long-term downtrend at this point. If they continue below this, they don't pop back up above them soon. Okay. But now let's get into this. So I'll show you like some current stocks I have at the moment. Some of mine are actually holding up, so I haven't sold these. So for example, I have Chipotle, and Chipotle is still above its 50-day moving average. eHealth still above its 50-day moving average. Overstock actually is. I'm not saying to buy any of these. I bought them at different points, and so it may or may not be a good idea for you. And I'd say it's probably not smart to add any positions right now until the market recovers. But any positions, I have a profit. I'm still thinking about this. When should you, should you sell them or should you hold on to them until your individual stocks? And I'm thinking I want to do that, and I'll show you the reason why, an example here. So, but anyway, I've got some that are still up above, and they're kind of bucking the trend of the general market. And if the general market recovers, they will recover stronger than the rest because they're holding up so well and bucking the trend of the general market that's going down right now. So I'll show you a really good example of that. So eHealth, this is one I had, and so last year. Like I said, I don't come to be a master here, guys. I'm just getting this, but I think I've gotten pretty good at this stuff, and just wanted to share my knowledge. You can go watch my first video about myself. But so, for example, I had eHealth right here. I just left this just to remind myself, but I bought it right here, and all the other stocks in the stock market. So this is around November 2018, and so we look at the indexes here, and so November 2018, let's look how bad this was. It was like, boom, everything's crashing. And I got stopped out most of my other stuff. I'd lost some money. And then I was, getting scared and thinking, oh, well, probably should just sell everything else and kind of save myself. But what happened was, so we go back to, I have eHealth now. I'll tell you what I did and how I screwed up. But so I had it here at $35, and then I sold it just probably somewhere about here. Whenever it dropped here, I was like, oh, everything else crashed, and it's going to crash too, but I should have just held on to it as a very small pullback. And what happened was, it held up even though the general market was crashing, right? It went sideways, but didn't even break the 50-day moving average. And what happened? As soon as we had the rally right after Christmas here, when the whole market recovers, boom, eHealth takes off. It's pretty much one of the strongest, if not the strongest stock in the market. Pretty awesome. You'd have had about almost 100% gain in a very short time right there, and then consolidated here for a bit and then going up more. And I ended up buying it recently because I was just like, but I was just kicking myself. It's like, man, why did I not hold on to that. And so it kind of taught me a lesson. Okay, any stocks I've got in a correction, I want to hold on to them if they don't stop me out, if they, don't break at least their 50-day moving average, let's say. And so I actually have a couple right now that the market's correcting. It's a smaller correction, not as big as October, November, December time last year, but have some still holding up. So we'll see what happens if the general market recovers and then my stocks hold up, then these ones will probably be outperformers going forward, the ones that do hold up to the general market correction. Or if we have a really big correction, all of them will probably correct and get stopped out of all of them. So it's that's how you use the general market and its trend to kind of know what to do and if you should put on any more positions. But if it's below whatever trend time frame that you have, either you can take off your positions if you just want to go to cash and just be totally risk averse, or don't put on any more and just hold on to your existing ones that are still holding up against the general trend of the market. So that's how you use the indexes and the general trend of the market to trade your stocks and kind of know what to do with them. Like, subscribe, hit the bell, and let me know what else I can do. Need some more followers here, guys. Let me know what I can do. We're just trying to share here. If you got any questions or any other video ideas, things you'd like to know me to teach on, and I'll try and do it.